Listen, I listened to some of the other AI founders, and I'm like, man, like once I knew you guys were gonna have me on, I was like, I'm gonna appear really dumb because some of these people are really smart, you know. So I just hope on like a level of dumbness, people are kind of like, okay, well, you know, Jason's like at least half as smart as the other people that you've had on, and that'd be like kind of reasonably good accomplishment.
I think you nailed it.
Perfect.
I don't know if you're familiar with Top Gear, but we're not doing, like an intelligence lap times at the end of every show. But I think you nailed it regardless. That was a solid lap, Jason.
Welcome to AI for Advisors with Mark Heynen and James Cantwell. Every week, Mark and James break down the latest in the world of wealth tech and AI, and occasionally bring in guests to spice things up. This is not investment advice and not professionally produced. I am not real and not yet sentient. Now let's get on with the show.
Welcome to episode 15 of AI for Advisors with James Cantwell and Mark Heynen.
Hey, everyone.
How are you doing, James?
I'm doing great, Mark. How are you today?
Yeah, doing great. So today we are really excited to have Jason Wenk on the show. Many of you probably follow Jason on LinkedIn and social media in general, tracking his story, founding and leading Altruist, and really tracking his journey from being one of the earliest advocates of AI to acquiring Thyme recently, a Y Combinator startup, and incorporating it into Altruist as Hazel. So this is an interview we've been really looking forward to. I'm very excited to have you on, Jason. Really appreciate it.
Yeah, and this is fun. I think over the last few years, I've read less and less books, and I've listened to more and more podcasts, like a lot of other folks. And this one, it didn't take long, like 2 or 3 episodes, and you guys cracked my my heavy rotation. So it's a real honor to be joining you. Yeah,
I love it. This is like legit now.
Yeah.
Legit. We were wondering, are we going to make it to episode 20? We every time we say which episode number is, we're like, is this really, this might be the last one. So appreciate that. Appreciate the validation. We also always say there are probably more productive things you can be doing with your time right now than listening to this podcast, but you're probably trapped in your car. So you're stuck with us for the time.
I don't know why you keep volunteering that. Listen to the podcast. This is how you should spend your time. We're going to summarize what's going on. We have great guests. Listen to this.
Well, let's get into it a little bit. Let me just say from the outset, custody is boring. Sorry, Jason. Generally, it's very boring, but actually, you've made it exciting. I think it's boring until someone decides to build it from scratch. So for those who don't know, Jason spent 6 years and raised nearly $500 million to build Altruist. We'll get into the story a little bit. Altruist was a custodian designed for growth-focused advisors who refuse to settle for legacy platforms. What we really want to get into is the Challenger Bank story. You've built this from scratch to challenge the larger custodians, but then also the journey of actually building out AI and your early thinking around AI and where you maybe had trouble bringing that to reality. Something I'm thinking about a little bit here is what is the actual path for a very successful wealth tech firm, and what learnings have you had along the way outside of drinking smoothies in the morning and wearing clothes that are all the same brand? Are there any other takeaways that founders might have?
We're going to have to get into this later.
Inside jokes already.
I know, it's fantastic. Yeah. Go ahead.
Yeah, well, I guess if that was the question, so what I'd say is like, that's a lot of question. And so I'll try to give you a reasonably short response, and then you can probe where appropriate. But I'd say so if I think about Altruist and kind of the journey so far and kind of what's in front of us and how would we define a successful outcome to this venture. One of the best ways to frame that is actually like zooming way out, thinking 20, maybe more years into the future. If there was to be an entirely new industry leader, right, to emerge in the U.S. wealth industry, like what would it look like? Like what would the attributes be? And then who's positioned today to potentially be that company? So it could be the incumbents. You could say, well, today Schwab or Morgan Stanley, these they might be at the top of the rung today. Fidelity, those are all leading companies. Maybe a bit more of an asset manager. You could say Vanguard is up there. They still have a very large consumer business as well. Then you have some up and comers they're very big companies, but they're newer, like a Robinhood, probably way behind. In that pack, you might still say there's companies like Wealthfront that are kind of been around a while and do have, north of 1 million consumer customers. So you kind of look at like those different types of companies. Maybe even there's some people that are not like that are maybe not as well known, but they're kind of building pretty meaningful early stage companies. I think of like a Human Interest, which is like a workplace product, that's kind of taking a different angle. So I think in a lot of respects, Altruist is just taking a different angle. So like these are all these different companies. Some are already at the top. Others are kind of like, how do we create this better leader in wealth? And our approach was to tackle it kind of B2B through the registered investment advisor market. And the original pitch was that not that Altruist was going to be a custodian, is that Altruist was going to be a vertically integrated wealth platform. And in vertical integration, at the base of the product would be a self-clearing custodian, right? So like when you think of integrated software, you have different things that are all kind of nicely stacked on top of each other. They work very seamlessly. So although we're probably known mostly for that base layer, Altruist from day one was also effectively like a middle back office for advisors, a front end application for consumers, a bunch of different integrated tools like fee billing and portfolio management and mobile app and on and on. Right now we have AI tools for advisors. But I think if I'm taking my best guess at like the 20-year race, I think we're positioned pretty well to become like the leader in the entire wealth management industry 20 years from today. Now, in order for us to do that, we have to continue executing really well on the advisor side. So we have to continue kind of adding, we're growing pretty quickly on the RA side. We very intentionally tried to focus on advisors that we believe will be the most important segment of advisors 20 years from today. Not tomorrow, not in 3 years when some...
Yeah. So who is that?
Yeah. Well, if you're...
Can you name them?
Yeah, you said it.
If your owner or your controlling owner is in the middle of like a fund cycle, meaning like they're literally a private equity firm investing out of a fund that has a whatever, like 3 to 5 or 5 to 7 or 7 to 10, whatever it is, fund cycle, then your decision making is going to be based on how many years are left in the fund cycle. Because then you're looking for your next recapitalization. Who are you going to resell the business to, or you can try to exit the business or whatever. So we sell the predominantly, although there's some investor-backed entities, and advisory firms where the principals are the ones they're the owners, so they have a time horizon that's going to be measured in decades, typically, and they're growing pretty fast, and they're doing it organically, so they're not relying on. Things could be taken away from them, like custodial referrals or, cheap access to capital and arbitraged M&A deals. Like they're just out there literally winning clients because they're a great, they're a great advisor. They're doing great planning. They're delivering great service. Right? So they're growing for all the right reasons. In ways that are sustainable and can compound for, again, many years. So that's our current angle of attack, right? Kind of like how we're going in. And I think if I was to look at that segment of the market, there's enough demographic data out there that over the next couple of decades, those advisors are going to eventually have trillions of dollars in assets. So even if today they only have maybe 1 or 2 trillion of the current, let's call it 9 to 10 trillion of RIA assets, I think with the market's growth this year, it's probably getting close to 10 trillion. The main people we serve are probably only about 2 trillion of that market, but it's the 2 trillion that I believe that when the market goes from 10 trillion in assets to, let's say, 40 trillion, I think the 2 trillion that we go after today is going to have at least half of all of the 40 trillion, in 20 years. And I think we'll probably do a lot of other things. Again, it's designed to be a platform business. So although custody will always be a big part of that, there's a lot of other things that we'll do, including like the AI projects and just other things that make sense to kind of integrate, into the wealth stack.
So Jason, you talked about kind of the growth of the industry. And if we go back a little bit to maybe your origin story, you obviously are familiar with some serious growth. I had to fact check this a number of times. FormulaFolios is the growth rate of 14,000% over 3 years accurate?
That is accurate. Yeah.
That's an insane number.
It was actually higher than that for a while, but that was the Inc. Inc. 500. The way that they do that is you your base year, your first year in that calculation, you have to have over 100,000 of revenue. So that way you can't get somebody who has like, $50 of revenue and then they all of a sudden have, 5 million or something. So you have to have like reach some, the minimus scale,
initial,
but nonetheless, like some amount. Right. So after what we went from, let's say we went from like a few 100,000 to 30 million or something like that. Like then that's how you get your 14,000%. Right?
That's incredible. Yeah. So, Inc. 500, fastest growing company, 4 years in a row, peaked at number 10 in 2017, and then acquired by Brookstone Capital Management in 2020. And I imagine that's when you were wondering, okay, what's next?
I mean, partly. So I actually started Altruist in 2018 before I sold my last company. I originally had this like romantic notion that, I'll just make it it was a privately held company. I owned 100% of all voting shares. So, I basically was like, well, maybe I'll make this like a portfolio business. It was very profitable. So it was a bootstrap business where I funded it privately. And, so I had nobody sitting there being like, oh, you have to exit, or we're looking for, whatever, some type of big liquidity event. It was just a business that I started and grew, and it was an LLC. So over the years, I'd granted a number of profits interest to different people, key employees, and so forth. So there were other shareholders, but I was the only Class A member. Right? So I owned the founding shares, basically, and controlled the whole company. So I thought I could do that, but I'd say like during that time period, I mean, the short version is if you've built a fast-growing firm, things that would be inconvenient but tolerable to a regular advisor are massively painful to a very fast-growing advisor. So, for example, having to do DocuSign envelopes and waiting a few weeks for accounts to be opened and funded and traded. Okay, if you're only doing that 10 times a year. Painful if you're doing that 50 times a day. And there's even a 5%, not in good order. Like you might be sitting on a few hundred pending apps on top of like the fact that it might take 4 weeks. So if you're doing, again, 50 a day, you've got, I don't know, I guess that'd be multiple thousands of like accounts in some type of pending state or follow-up state. So, so I felt the pain of account opening pretty acutely by going through that, 13,000, not some odd percent growth rate. And what I try to remind people too, I do this because this is one of those things, like the older we get, the better we were. Every now and again, I'll see some firm and they'll be like, we went from, 1 billion to 3 billion. And I'm like, we went from 0 to almost 4 billion, and the market was 1/3 the value it is today, right? Like the market's like went up 150%, 160%. So us, when you're adding $1.5 billion a year in 2016, it hits a little bit different than doing it in 2025. It's harder.
So people are having a harder time now than they were back when you were having this hard.
And we're smaller, so you had to open a lot more accounts, right? And everything was different back then. You still had commissions. There's just a lot of like pain, a lot more pain back then than there is today.
Right. And you're a bit bearish on private equity roll-ups, I understand, right? So let's, hold a candle here for the private equity folks who need to take home some money for Christmas.
I'm not like bearish on that. So I think it's a brilliant idea if executed really well. Like I'll give you an example. This is going to sound self-serving, but we have a firm doing this in Altruist right now. They're in stealth. They'll come out of stealth probably sometime next year. But there was someone who, they were looking at that whole private equity roll-up space, and they go, gosh, most of these big firms, they look pretty much the same. Like, I mean, you could like blur out the logos and just look at like how they describe themselves. It's very hard to tell them apart. Like, they all have the same custodians, the same tech stack, kind of manage money the same primary methods for growth and custodial referrals. I mean, and that's the majority of like the top 20 RIAs in the country. And so someone came along and they said, these aren't exactly great businesses. They just have like these insane tailwinds, like cheap access to capital with kind of a lot of retiring advisors, an arbitrage in valuations, right? They buy for 6 to 8 times, but they believe they're worth, 20 to 25 times. And, not really any pricing pressure. Like prices have pretty much not changed in this industry, meaning like advisory fees haven't changed much in 25 years. And so, you can be a pretty average company and look really good, because you have all these tailwinds. It doesn't hurt when the market's just ripping behind you. So firms you bought 2 or 3 years ago, they look like these killer deals. because the assets have, doubled or whatever, but it's not necessarily because of, great organic growth or insanely high NPS or, great product satisfaction. It's just a bunch of tailwinds, right? Like we have to admit, like we got a little bit lucky, and a lot of people aren't willing to say that like the timing of all of this confluence of things has been that beneficial. So anyways, there's one firm, they came, they're like, what if we built an entire aggregator strategy on Altruist? And we built the whole thing, like we're not going to use any third-party software. We're going to build, basically we're going to take what Altruist offers and what Altruist doesn't offer, we're going to build that AI first. And we're going to build the stack from scratch. We're going to recruit a absolute amazing technology team. So, the founder is literally like an off the charts brilliant technologist. When he comes out of stealth, people will be like, never saw that one coming. Like somebody coming from like, get a pure Silicon Valley background, like all of a sudden coming into space. Engineering talent, like off the charts good. And they're like, so what if we should build an insanely good platform? And then we levered on the private equity kind of component. And when they do it like that, I'm like, that's a great way to do it, because they're able to go buy a firm that's very inefficiently run with a bunch of cobbled together software, that's using the traditional custodians. And then after they make the acquisition, they move all the money over to Altruist and to their sort of AI native operating system. And the efficiency gains are off the charts. So it becomes like a really, really good business. And they don't rely on any custodial referrals. Like they're all about like, building killer, again, AI driven automated growth, within the client base. So a lot of it basically being things to generate a lot faster organic referral growth, very kind of agentically and with like a high degree of precision in the way they measure and scale it. So it's been fun to watch. So we have that firm already on Altruist, by the way. They're killing it. And they're going to do really, really well. When they come out of stealth, people will be like, so I'm not like, you don't have to fully like.
So sorry, this is an RIA. This is basically a tech forward RIA that you own, if I understand correctly. And
I don't know. No.
Oh, okay. So that you're collaborating with them and they're effectively, building from the ground up to be more tech forward to just have much better outcomes.
And then they're using private equity dollars to go do acquisitions, right? But instead of acquiring into the same exact thing that everyone else is doing, they're building it to be actually insanely efficient. So I think the model of using acquisitions to buy firms, it's not a bad model. I find it to be like, if you have 50 different firms all doing the exact same thing, that feels a bit dangerous to me, and especially when they're all having a bit of a problem retaining what they call like Gen 2 or next gen talent. Like after you do all these deals, at the end of the day, somebody has to take care of those clients. And so you're going to ask people to be W-2 employees to go take care of all the clients. At some point, those W-2 employees are going to go, well, why don't I just go start my own RIA? And like the whole cycle just goes back to the way that this whole RIA industry grew in the first place, was where people were like, I'd rather just own my own firm and do things my way versus be an employee advisor. And what we're now doing is we're buying all the independent entrepreneurial advisors and then asking people to join as employees to go work there. And we've seen how this plays out. It's just a matter of like, will it be 10 years, 15 years? We'll see.
Well, this reminds me of these plays where, technology companies have such difficulty selling into a sector. They just end up getting backing to buy the customer and then, basically doing a private equity play. So Metropolis in parking, I don't know if you're familiar with them. Mm-hmm. They basically bought a whole bunch of parking garages and infused it with technology. Constellation Software is another example. They buy about 200 plus companies a year and in old, boring verticals, and then they infuse it with software and then they flip it on the back end. So it actually feels like that might be an interesting sort of analog to what you're talking about.
Yeah, totally. Yeah. No, I think there's like, again, there's a lot of really smart ways to do acquisitions and to reinvent industries. One of the fastest growing RIAs that I've run into over the years, their whole strategy is buying accounting firms, right? So they happen to have a big tax practice. They buy accounting firms for effectively like one-time, revenue multiples. And then they cross-sell wealth management. So they're only buying the asset purchase, right? They're just buying the accounting clients. And then they're trying to say, hey, can we convert 10% of those accounting clients to wealth management clients, charge an AUM fee? Now our ARB is, whatever. We've just created 20x EBITDA value business on something we paid almost nothing for. So there's lots of interesting creative ways.
It's a brilliant model. I mean, one of the challenges, right, with organic growth, one is obviously the lead gen process itself, and then knowing kind of what's the opportunity for growth of wallet share. Now, here's a accounting firm that, you acquire. They're obviously, their wallet share is technically zero, but they immediately have full visibility into all of it. I mean, the tax documents tell you everything they own. So they have immediate visibility and know exactly where to target. And they can probably learn that information during the due diligence process. And so it's kind of a no-brainer. It makes a lot of sense. I'm surprised more aren't emulating that.
Well, we might see a big pickup after the whole world listens.
Yeah,
I mean, they're
come here first for your alpha.
That model is not a secret. It's just not one that others have chosen to emulate. But it makes a lot of sense. Let's talk a little bit about Altruist as a platform. And I have one maybe kind of easier question to kind of kick things off. How long did you have that domain name before you used it?
Long time. Probably maybe.
I read
maybe
15 years.
Nah, probably not that long,
okay.
but at least 5 years. I mean, I only started FormulaFolios in 2011, and I bought it while I owned FormulaFolios. So probably, maybe
around time.
Who knows, 2012, 2013, something like that. But, and actually I owned another company it was called Altruistic Financial Planning. So like there was a little financial planning firm that I owned a little tiny piece of. And so I kind of had this name, this idea, altruist and altruistic, kind of playing in the background for a while. But so, and to wrap that story before about like the starting time period. So I got so frustrated in 2018 running the old firm that's why I started Altruist. So I started it while having the old company, but I had the name already. So, I don't know what the domain would be worth today, but probably a decent chunk of money.
Good domain.
I think I paid $30,000 for it back in the day.
I mean, I think some of the best products come from solving your own problems. And so, I mean, I think tell us more a little bit, I guess, about that origin story. So you had this pain that you saw, decided to build something different. And I think one of the things that's very interesting, and you touched on it earlier, was that the self-clearing model, right? And so you guys acquired SSG at some point along the way.
Yeah, two years ago.
Okay.
Yeah, I'll rewind. So I'll just share like a little bit about the pains because maybe some other advisors can relate to this, and then I can get into the SSG kind of component, But
sure.
So the pains, I talked a little bit about account opening being like a big pain point, right? And around that time is actually when I observed Robinhood. Now I'd known about them for a couple of years, but I remember I downloaded the app for the first time and was like, "This is insane that you can effectively download this app." And in 2 to 3 minutes, you can open an account, you can transfer whatever, $10 if you want to, and you can pick a stock that trades for $500 a share and buy $10 of it. And do it all on your phone, all automated, never have to talk to a human being, delightful user experience. It was very efficient, and it made me immediately almost angry, that like our wealth tech, was so far behind. And it was especially frustrating because I was on the Fidelity advisory board. I was on Orion's advisory board. I had good relationships with senior leaders at TD Ameritrade before they were acquired by Schwab. I mean, I'm sure I wasn't the only one, but I certainly was a loud voice talking to all these vendors being like, we need something better than what we've got. Like DocuSign cannot be the solution. Like that cannot be like the be all end all. And there were very few APIs. My company, we had a good sized engineering team. So we built a lot of our own kind of middleware and onboarding software and prop gen, and got about 30 software engineers at FormulaFolios. So we had a good, for an RA, that's a pretty good sized engineering team. And it was based in California. So high quality talent. Like it was a good group of talented engineers. And we still could not get this stuff. I mean, we were so far behind. It was like literally being like non-exaggerating. It's like the true horse and buggy compared to like, a Concorde jet or something like that. And I'm like, what are we doing here? And so I complained about it for a while, but beyond account opening, the other things you start to become very problematic if you have a successful RIA is once the accounts get open, then you have to manage the accounts. And if you're buying whole shares, that was like one thing that really frustrated me. FormulaFolios, we had this, kind of like our company slogan or kind of motto internally was an investment firm with an obsession for doing good. And we talked about doing good on 3 levels, doing good, within our company, kind of the way we treated employees, wages. It was very, very that kind of coveted job to get in the area I'm from in Michigan because we paid really, really well. Like we had a company-wide minimum wage, I think of $45,000 or $50,000, and this was again over 10 years ago in the Midwest, which that's a good job to get, at the very lowest end. And we had a bunch of other stuff we did. Like we were one of the, I think maybe the first, if not the first, certainly one of the first ever certified B corporations. That was an RIA. We were part of 1% for the planet. We were WageMark certified, which meant that nobody at the company could make more than 8 times the lowest paid person. So if I wanted to make $800,000, I had to pay everyone else $100,000. Right. So we did all this stuff, right? Do good for each other, like in the company. Do good in the community. We did tons of community service. A big part of like you take the job, everyone had to commit to a certain number of hours of community service. It was a lot. I think it was like either 40 or 80 hours of community service to be an employee, all paid for by the company. And then we had doing good, in the industry. So like we wanted to set a new standard. We wanted to have no account minimums. We wanted to be able to serve clients, all levels of wealth, right? We thought we could do those things. So we did a lot of things that were that were kind of forward thinking. But the problem with that is now you have clients that have $5,000, $50,000, $500,000, $5 million, $50 million, and managing all of those different portfolios at scale once you have 50,000 or more clients like we did is insanely hard. It's like, because you had to have like, here's how we manage money if you have this small amount of money, and here's how we manage money if you have a little bit more than that, and here's a little bit more than that, and then a little bit more than that, right? So, and then you have all the efficient frontiers of asset allocation models, and you kind of get the idea. All of a sudden, you're running like 40 or 50 different client portfolios. You have all these people with restricted positions. It became very, very challenging to manage the portfolios. After you figure that out, which that's no small feat, then we had to figure out like, well, how do you manage cash flows? This became probably like the bane of my existence, was managing cash flows. You have, again, 50,000, 100,000 clients, multiple hundreds of thousands of accounts. And, you're going to have inevitably a ton of ACH in, ACH out. You're going to have RMDs. You're going to have QCDs. You're going to have donations of appreciated individual securities. And again, if you only have 100 clients or so, it's a nuisance, an inconvenience. You do this for that many people. I mean, it's like a team of 10 people's full-time job with so many points of failure that inevitably will make mistakes, and we would have to pay out, $300,000, $400,000, $500,000 a year in errors because like the software couldn't keep up with the complexity.
Well, this actually gets into like sorry to interrupt, but like this gets into a fairly fundamental question, which is, I understand you wanted to sort of build a better sort of operating system, for lack of a better word, or way of operating for advisors. But attacking that from the custodian point of view, where you're basically taking on the most entrenched competitors and taking on the gnarliest sort of back office tasks possible. I mean, I think you yourself said you can age 20 years and 5 by trying to start a custodian. Like, why did you think that was the most leveraged spot to actually start from a product point of view?
Yeah. So, I mean, if people are watching the video, go Google my name. See what I looked like when I started the company. Great hairline, long, rich beard, no wrinkles. Now I look like a grandfather of the guy who started Altruist. Jokes aside. So here's kind of the why behind it. So again, my last company, we built all the other software you could build on top of the infrastructure layer. If the infrastructure is bad though, you're kind of stuck. Like where do you possibly go? And the other part was like the economics had a real stranglehold on a lot of these outcomes. So if you try to fundamentally go, well, why doesn't everybody offer fractional shares? Why don't they? Like the technology's been around forever, decades. Like why doesn't everybody just do it? Flip a switch, boom, everybody has fractional shares. Well, if you did that, then everyone would have less cash in their account. You had less cash in your account and 50% or more of your revenue was based on net interest income. You might literally go out of business. Because if that cash drops in half and there goes half of your revenue, and if your EBIT margin is 25%, you literally just became a nonprofit. So of course the custodian is going to have a bias that ironically is a conflict to the advisor's fiduciary duty. The advisor's trying to do everything they can to put the client interest before their own, help the clients get the best possible outcomes. And some of the custodians are like, well, I mean, we'd kind of like to help you do that, but we only to a certain degree, because we got to make some profits too. And that's totally fair of them. But the way that the custodial revenue model worked was incredibly esoteric, very complicated, very opaque. And most people didn't even really understand how it worked. They truly believed that commissions were how custodians made money. And so it'd be like, oh, how does your custodian do all these things for you? And the advisor would be like, oh, well, they charge a fair price, $7 commission. It's like commissions, meanwhile, are 5% of their revenue or something like de minimis. So I kind of felt like you had to go down to that layer because that's where the bodies were buried. And that was really the rate limiting factor to building great software. You had to have a modern clearing and custody infrastructure. This would unlock the economics. It would allow you to build really beautifully integrated software. And frankly, it's still partly why, like, you guys have all the AI guys and gals on here, and that's the name of the podcast. And I'm a big, big believer in where AI can take this industry. But if you take world-class AI and it allows your firm to be the most efficient firm you've ever been, your client service is the best it's ever been, your communication is off the charts, all your clients are ecstatically happy, and all they want to do is refer you more people. And then you go to try to grow your business on top of old, crusty infrastructure. The AI did not help you. Like it's like you drove you into a path of lots of pain trying to manage a business now that's growing really fast on bad infrastructure. So to me, like, everything else is like somewhat irrelevant if your infrastructure is not scalable and sound, reliable, efficient, automated. You have to start there first. It's insanely hard. It's super expensive.
From a consulting perspective, it's super simple. There's really kind of two things. There's one, we have to clear all the bottlenecks, right? Identify what's a bottleneck, clear those out of the way. And then step two is, how do we turn on the engine, right? Like, once we've figured out what's going to slow us down as we start to scale, then it's moving on to actually bringing that business in the door and moving it through. And so I love the way you've thought about solving for these problems that are not necessarily, sexy problems, but they're an absolute barrier to really growing your firm at a high rate. What I'm curious is this. I have a question for you, and this is straight out of my own curiosity. I see the value of Altruist as a custodian, as a platform. What if I'm multi-custodian and you're one of my custodians? What does that look like? Do I start to lose a lot of the value unless I switch all my assets over?
So short answer is,
it makes sense. Yes.
The short answer is, you might not want to be multi-custodial, to me, it's one of these weird things. I've had this, before I started Altruist, if people would have asked me, what's the number one thing I wish I would have done different at my last company? I would have said, I wish I only had one custodian before I was in the custodial business. And part of the reason why is, again, if I look at like inefficiencies, we were a tri-custody firm, Schwab, Fidelity, TD Ameritrade. And what that meant was that we had 3 different workflows for every possible thing you could imagine doing. Now, maybe you could synchronize your trading through fixed trading protocol with like a third-party trading tool, but you definitely were going to have different forms libraries, and you're going to have different customer support numbers, and you're spreading your assets around, so your scale was limited at each of those 3 places. Even if you were a good sized firm like we were, when we were at $4 billion, we were probably $2.5 billion with Fidelity, which basically was a rounding error for them. And so you can imagine that Schwab and TD, we were equally insignificant. So I always get a kick out of it when a firm's like, okay, now that I'm at 300 million, I think it's time to add another custodian. I'm like, do you just want pain? Do you just want worse outcomes for your customers? Do you want to create a worse place for your employees to work? That's the only, I can't think of exactly what you're doing that's beneficial, especially because all of the major custodians, all of our money is in the same place. I don't know that advisors fully understand that. Like, when you see an ACAT eligible firm and they have what's called the DTCC number, that means the money's actually at DTCC. So, that's where the actual assets are held. And when we do an ACAT, what's happening is my firm has a box number. That's, my DTC number. Schwab has one. And when DTC receives those instructions, they literally take those securities that they're holding and they say, oh, those go from, the Altruist box to the Schwab box, right? Literally nothing changes. There's no different location of assets.
Yeah.
So this notion that like I'm benefiting by having multiple custodians is kind of a farce. Like, the money's all in the same place, same SFIC insurance, same exact reinsurance, same reinsurance amounts, same reinsurance companies, Lloyd's of London. Like, it's like, so I do think, like, if we were, now, why do people do it? Who knows? But I think there was like somebody said once upon a time that, you should really be a multi-custodial firm. It's a real advantage, and they came up with 4 or 5 things that seemed reasonable. It's kind of like if somebody makes up something.
And now that's stuck.
Like something that's like totally make believe, but it seems like it could be kind of reasonable. And like, then people just start believing it to be true. And before you know it, the game of telephone happens.
SVB or any of those things have an impact on that? Or does this predate some of those more systemic things?
No, predates that. But even then, like, again, like people, if we think about like, so banks are obviously a lot different than custodians, right? So banking assets are commingled assets. Like, you put your money on deposit, the bank lends it out. If you have securities, those are held in street name, like they're not pooled with everybody else's assets and like lent out, to bad mortgages or something like that. Like these are just actual equity assets. So I think there's a lot less in my career. Again, I've only been doing this for 26 years, but I've never heard of anybody ever losing stock that they owned at a custodian, like ever.
Yeah.
Like,
so it might be not solving the right problem, right? So I guess the benefit of of people being single custodian with Altruist, you get the benefit of all the additional layers of things that you're adding on. And I do want to get into what your relationship is with AI and what you're trying to build in AI. But before we do that, I know Joe Moss had a very specific question for you, which is not only are you building your CRM, have you already built your CRM? I do want to make sure we address that.
Is that a standing question for every guest?
It is a standing question because we don't know who's building one, because you can build one in an afternoon these days. So you might as well.
Yeah. No, we're not building a CRM. When I started the company, the two things I didn't ever intend on building were CRM and financial planning. I just, didn't ever see a reason to build them. And the other part too is I feel like with financial planning software, advisors can get pretty religious about it. It's like, if they're using something, they might be like, I built my whole firm around this like very specific value prop. And I'm like, I don't want to have to like try to do something different and better. I don't think it's particularly differentiated. CRM, I find the same way. I mean, I say this with like the utmost respect for those that are building CRM. It's an important, necessary software, but a great way to think about it for us is that if you just think through like, okay, like who are the 10 largest companies in wealth management measured by market cap, right? Like, let's say, who are those? And I don't know exactly what they are, but like what you're going to get is like Fidelity, Schwab, BlackRock, right? Like, I don't know, like you're going to get like these companies that are $100-200 billion companies. What you're not going to get is a CRM company, right? So we're just playing in a different universe, I guess, than like a traditional software company. Like we're trying to go after a big, hard, complicated market. And the last thing I need is the distraction of like building a SaaS product that, market domination looks like, I don't know, $40 million of revenue or something like that.
Not enough TAM, basically, is what you're saying.
It'd be very distracting against this like much larger, much more important kind of thing. So, so I don't know that that's one. And that being said, I think like the spirit of the question, which I do think is an interesting one, and I don't know, I think James had some good quotes that are now becoming part of the gospel here, but it's like, why do you need a CRM anymore? At what point do people just kind of like this, the acronym, customer relationship management or contact relationship, whatever, I don't know what the specifics are, but I'm like, because once you build like the right data pipelines and everything aggregates in, you kind of run a canonical model around top of it. So you now have like this very clean, you then enrich the data. And all of a sudden you've got this really accessible data and, use any type of modern chat interface and you just query it. You can create visualizations. I mean, all of a sudden you're kind of like, what did I use the CRM for again? So
exactly. Yeah, I mean, you could argue Hazel is a CRM, right? To your point, you could argue you've already built one. That's sort of where I was going with that direct.
I mean, we definitely aren't
Interesting
we're not trying to do that, but what I'd say is like the like it is it's a question, right? And I'm sure Parker and anyone else, right, at Jump or Mark at Zox, like I'm sure you guys maybe get this too, Mark at Knapsack. Like inevitably, people will use your product and then they will say, "This kind of feels like I don't need my CRM anymore." Our response is like, well, we're not here to replace your CRM. Like we sync with it. We're that's just the reality. But look, the question will come up. And that's why I think like if you're a smart CRM company, you're going hard at like integrating AI tools into your product because, I think the market has spoken. There's probably 50,000 people that signed up in the last 12 months for AI first productivity software, advisor software. So mostly meetings and things like that. I think that's probably more than have signed up for new CRM products in the last, 10 years combined.
Yeah. So it's solving a bigger problem. And so, I mean, Ray Nami asked, what are you not going to build for Altruist? Sounds like a CRM is something you might not build. But then, of course, there's other stuff you may build on top of that might be productivity focused, right? And so I think that's really interesting, that dichotomy.
Yeah. I mean, my view is generally like, I don't want to build software to replace software. I'd rather build software to replace human work. Not to say humans, but like the work that people would otherwise have to do. That's incredibly monotonous and, error, potentially error prone. Maybe we're not even maybe we don't even like doing it, but somebody has to do it. It's kind of like the lowest value work that it's hard to keep employees engaged in doing. So like those are the things that are better. And then, like the natural evolution of agents will be tackling more and more complex work, and then eventually more and more, customer facing work,
Right.
where there's maybe some customer interaction. So I think these are really interesting things to solve for. But like building like cloud software is not of high value to me.
Yeah. I mean, just to your point on TAM, I mean, for those who don't know, so Altruist has, latest numbers I have here, 6.25% market share versus 45% Schwab, 18% Fidelity. So still a lot of room to grow against some of the incumbents that you mentioned. 5,400 advisors and tripled AUM 2 consecutive years. So clearly on a tear. What you're doing seems to be working. So let's talk a little bit about your relationship with AI. So my understanding is 6.5 years ago, you had it in a pitch deck. The advisors weren't ready. And then you've obviously been thinking about it, and you, went ahead and acquired Thyme to build out Hazel and launch it. I was wondering if you could give us a little more behind the scenes. What was that initial experience like pitching AI to the extent you did or thought to build it? And then how did you come to the view that acquiring was the way to go? Would love a little more detail there.
Sure. Yeah. I mean, going way back in my first, job in the industry was at Morgan Stanley, and I was on a team that we were building neural networks and trying to write genetic algorithms to do mostly risk-based trade parity. So we were doing risk calculations basically on spread trades. And the math has been around for a long time. I mean, if you guys may have done some of this as well in earlier parts of your career. Sort of philosophically, what's possible with AI has been around for a very, very long time. The challenge was, you didn't have access to, latency. So like we literally set up data centers like across the Hudson River, to try to get close proximity, to exchanges to actually action upon the slim edge we're getting. You needed massive, amounts of hardware to do the same amount of compute that today is could fit in the data centers are still big, but on a relative basis, like the number of watts that you're able to get out of an LLM today because of both access to better hardware and faster access to information is just, it's 2 decades ahead of where it was 20 years ago, right? So you can just do a lot more with it. But yeah, that first version, we had it built in. It was like one of the primary value props I thought was what we called back then altruist intelligence, kind of simply named. And we've had a number of prototypes, put those prototypes in front of advisors. And it wasn't just the AI prototypes. It was like kind of the whole platform. And the common response was like, I love what you're doing. These designs look amazing, look so clean. My one piece of advice, I'd get rid of the AI. Like, it was like almost unanimous. Get rid of the AI. That's the one thing I don't want. All this other stuff you're talking about, lightning. Well, I think it was that they didn't trust it, right? It felt uncomfortable. And I really do think it took ChatGPT to get everybody to feel a little bit more comfortable utilizing AI. Because in those days, like the original AI that we had, it wasn't necessarily like meeting assistance. It was much more like almost like an agent for doing portfolio analysis, making recommendations, helping outreach to, do outreach to customers, uncover new assets and opportunities. And so that maybe was a bit of a reach, to like versus like, hey, just click this, have this thing join your meetings and give you a nice summary. Like that feels a little bit like, lower key, I suppose, or just like chat into this interface and you can do it in the privacy of your home with like nobody will laugh at you or, like it's like, there's no connection to your data or whatever. So yeah, it just took some amount of time. I mean, I think the good news here is that like even on our core product, like we started thinking about data architecture very early on, and I think it's pretty well known now that if you don't have access to clean data, it's hard to get an LLM to give you highly accurate responses. It'll fill in the blanks in the data it doesn't have, and so you have to have very complete data, ideally organized really well. And I'd say specifically tabular data in a perfect world, so it's very easy to reference, the source. And so we've had that. Like, I mean, if you think about the data architecture at Altruist, it's always been, part of it's been because we've been taking in data feeds from other custodians, and we've had data integrations with CRMs and financial planning companies for years. So we've always had this notion of like the data comes in, it's in these unusual file formats. There might be some general commonality, but they're not perfect. Right. we need to synthesize all this into basically a canonical modeler that cleans it all up, makes it one very kind of accessible database. And then at Altruist, all of our different products, they call on those same data APIs. So if you're like on our accounts team and you want to be able to pull previously saved beneficiaries that were using some other thing, like that data has to be existing in like a single database. Same thing if I'm going to run like fee billing, like again, like you're hitting a lot of the same data architecture on our core platform all the time across all of the internal APIs. So when we started building AI, we had a pretty good head start in the fact that we had like highly scalable SOC 2 compliant data architecture in like one of the most highly regulated fields in the world. And so, so that was kind of like the early days of kind of like how we thought about the product, advisors not being ready, but us having the right architecture. The first thing I noticed was the note takers. And I just was like, I very early on, I was like, so I'd say like over a year ago, I was like, I kind of feel like this is going to be something that takes off and gets pretty big in this industry. And, I don't know if it's speaking out of turn, but I reached out to both Zox and Jump in their very early days. And I was like, hey, just, kind of curious, what your guys' plans are. And how would you like to, maybe one day you could be part of Team Altruist, and, I think maybe I was a month or two late, because I think it was like they were just getting enough traction. I think they were kind of like, I don't know if we really want to sell just.
No, you didn't send chocolates. It's all about the approach. You got to.
I'm pretty forward.
That's the mistake.
Yeah, I'll tell people on the first call. I'm like, hey, listen, here's the reason I'm calling. I just want to be frank with you. Like, I'm kind of interested in buying your company. And some people, they don't like that. But anyway, chocolates may not have softened that one, but no, I had tons of admiration for what those guys were building, and I just kind of could see like, hey, this is going to go well. So I looked at a lot of the products in the market, and when I met Daniel and Fernando from Thyme, I'm like, this is an unusually good product for having so few customers. Like, it's actually it was well built technically, and you had two masters in computer science founders, both 2-time YC founders. They get it. They understand the work that it takes to build something. They probably should have raised more money early. And really, I think it was more of like they missed an opportunity, because once there was a clear, like once the Series A announcements came out from Jump and Zox, I think they, and maybe others too, like were like, oh man, it's going to be really hard to catch up to these companies that have $15 to $25 million and already have, 10 times our revenue. It's like, what are we going to do? Go out to the market and, try to raise some more money. I mean, it's just a hard thing. Like, so I think for them, it was, a great opportunity to become part of a well-resourced team. We had an AI team already that was actually 2 times the size of, they were a team of 3, right? So we had like 6 people. So we're like, hey, like now we're going to have 9 of us building AI, but it's been awesome. So I'd say like we took certainly components of the Thyme product, but we built almost the entire thing from scratch. I mean, we took some learnings and some key relationships. They had some vendor agreements in place, allowed us to kind of shortcut some integrations. They had some users and some user data, so we're able to kind of learn from those users more quickly. We quickly sunset some features that were like just clearly not that important, so we could focus the attention on more. We hired more engineers. The entire team is technical.
Just out of interest, what were those features that you sunset? That I presume there was like passion features that you found didn't get the traction.
Yeah, like I want to say like they were doing certain things with documents that just no one was using. And so we took those off. I'm trying to remember, there was a couple of things when they demoed, I'm like, oh, that's pretty cool. But then when you looked at usage, you're like, well, you've got 2 people using that feature. And right. Meanwhile, we've got 100 things we need to do. So let's like focus our efforts on like the 100 most important things. Yeah. I can't remember exactly what they were, but they had a lot of breadth of their product. It was sort of, I think they took a little bit of an approach of like, look, we're an early young company. Let's build a bunch of features and see if any one of them really resonates and is a strong differentiator. And I don't think that's necessarily the wrong approach. It's just, the benefit we sort of had was that we had thousands of users that love our product, our core product. And we could go to them and kind of say, hey, here's something we're building, and get them engaged very quickly to help us shape like what would be a highly differentiated, valuable product. And then we had the resources to go build it. So, and it meaning like we had like a proper like product management organization where you had, a PM, in our case, a PM that, was a very technical, engineer, and a team of great engineers, product designer that's incredibly good, like just really knows how to build like thoughtful, kind of user experiences. And so we could just move kind of quickly and start kind of iterating on the product. But I would say like the three guys from Thyme, like they're awesome. Like they're like incredible. Like it was like, I think in many cases, like a really perfect aqua hire where it worked out good for them. YC was happy. Like everybody's happy. It gave us probably a 3 to 6 month like jump forward, which as I'm sure you guys know, like in AI, that's incredibly valuable.
But it also committed you to the space. So I think actually just thinking through the investment memorandum you probably wrote to yourself as you were thinking through this, like what gives you the right to win in this space? Like why is vertical integration into a custodian such a strategic advantage? Because I think I would maybe counter your argument that, once Jump and Zox raised the A, there were category winners and everyone else is in the dust. The counter to that is that there's no real data moat. Everything's saved to the CRM anyways. So people can switch note takers every week if they want to. And so there's actually, once people get in the habit of using a note taker, it's wide open for people to switch. Of course, there's like the onboarding process, et cetera. There's some friction there. But yeah, what is the use case or the advantage of having something vertically integrated with a custodian versus, APIs being available and everyone can integrate with APIs from any custodian?
Yeah, no, I think good catch. And for what it's worth, I don't think there'll be a singular winner here necessarily.
Right.
I just think like right now, I don't know, there's probably like 15 of these things. And I don't see a world where 15 of them are necessary either in a few years. Like
sure.
At some point, the seed money runs out. And if there's not any real user growth, some of these things will sunset, maybe little asset purchases, by some of the ones that are a little bit larger. But I do suspect that, very well could end up being, I don't know, 4 or 5, leading like wealth platform businesses that are kind of AI first. And I define that when I say AI platform businesses, I think the note taker is already pretty commoditized. If that's the only thing you have, and you've got tens of thousands of users in that, you better come up with a good second act, because like at some point, to your point, the renewals come up, the prices come down. There is some advantages to having scale. Like our operating costs are just lower than most other people's because our core business is much larger. We have a lot lower costs for almost every form of infrastructure to operate our business than a standalone AI note taker would have. So I do think that now the benefits, my view is sort of like on the custodial integration part, I think it's when you start to build things beyond note takers, that becomes really valuable. And so, examples I give often, it's like, I had a client that unfortunately found out they had terminal cancer. They were going to pass away in, they believed 3 to 6 months. The irony, of course, is like they were alive right now and they knew they had 3 to 6 months to make sure they got all of their affairs in order. They lived in Illinois, which has very different state taxes than other places, very high net worth family. And, so they had a bunch of questions and, Hazel's able to listen in the conversation, but also grab the context of any past notes. Can look at the financial planning documents, can look at all of the custodial records, knows who all the beneficiaries are, knows what state the client lives in. The model's been obviously highly tuned, if you will, like tons of context given around, like, making sure that it's, accurate in its responses, instead of making up things. But very easily was able to go from taking notes to creating here's like the most important tasks that this family needs to take care of, and here's who they should be talking to. This is what your attorney should be doing. Here's what your accountant should be doing. Here's what we need to do with your accounts at Altruist, right? Like all of these things become a little bit easier if it's more than just a note taker. It's got all of the context of the custodian and the CRM and the financial planning documents, right? So I do think like once the data is largely centralized, you could switch from model provider or vertical provider pretty quick and easy. Where things get really interesting is when all of a sudden maybe there's like 2 beneficiary change updates, and other AI platforms might say, "Hey, I've went ahead and updated the paperwork for you. Here's the PDFs, right? And now you just need to fire those bad boys off to via DocuSign, and hope that the client signs them and gets them back to you, and then you send them in your custodian and process it, and like all these other things." Whereas at Altruist, it can just be like, I've went ahead and drafted the beneficiary updates. Just click here to review and submit to the client. Right, done. Like you've eliminated all.
Less of a daisy chain, I guess, is what I'm hearing.
Totally, yeah. And I think like you end up having, again, like if you're only doing this for a small group of clients, a little inefficiency is just a nuisance, not a big deal. if you're trying to build something that's, designed to drive optimal client outcomes, you want a good, unbelievable service, you want to create, kind of a, an incredible place to work where you're not doing a bunch of the busy work, but you're doing the big important work. I can tell you, like, the very human part of like that interaction is that family. I've known, I have 8 families I still work with this day from my days many years ago of being a planner. Like, we shared a good cry together on the phone. Like, we did all the human stuff. And then Hazel did all the non-human stuff. And that's the way it should be. So I think we have whether this notion of win or loser, I don't think is that important, but I do think that if a custodian wants to, they can open everything up via API and let the AI just kind of, push the data. But we have to keep in mind that you still cannot open an account via API at these other custodians. What makes one believe they're going to open up APIs for account servicing, beneficiary updates, RMD changes, cashiering? Like, you can't even get an ACAT done, right? Or anything with an API. So I think that maybe all of a sudden something massive changes, but if hope is the strategy, I'm not sure that's that relevant. What I'd rather do is, have AI that can do a ton of really useful things for me. If a big part of my business is managing assets for my clients, then I probably want, if I'm choosing like my rubric for like which AI makes sense, I'd probably say maybe I should partner with an AI that's going to work really well with my custodian. It can help me with a lot of these like agentic workflows around account servicing, asset management, discovery, and so forth. If I'm kind of more of just like a financial planner, like my primary value prop is like, hey, I just do plans for clients, it probably doesn't matter really, because you can do, like, now you're seeing like what's happening with Right Capital and others where, OCR is becoming irrelevant. You can take somebody's e-money financial plan and just extrapolate the data, use it to basically repopulate plans in any other software. It's really cool. I think, that like AI is making switching providers fairly easy, but it just depends what kind of business that you're building as.
So Jason, for our audience, I think what you just kind of alluded to was like a lens for thinking about how best to choose the AI solution, right? And the way I think about it is this: AI kind of originated, at least, in one of 3 platforms, and you're a leader in one of those. So one is kind of interfacing with the CRM. The other is yours, interfacing with the custodian. And then the third would be interfacing more so with the portfolio management application. And that's kind of like, as each of the products out there kind of started heavily in one of those, right? And so if you're an asset manager, the portfolio side might make a lot of sense, right? Things that make trading easier, investment research easier, performance analytics easier, things like that. If you're an advisor who's concerned about growth, it makes a lot of sense for something that integrates tightly with your custodian, like Altruist, so that you can smooth out the client onboarding, beneficiary changes, ACATs, and a host of, ACHs and a host of other things. And if you're an advisor who does mostly financial planning, things along those lines, and you don't have high account openings or some of those things that we kind of talked about at the onset, where it's a little bit of a nuisance, but it's not a big deal because of your scale, at least those currently that are kind of more CRM focusing are on the table for you. For me, it's kind of like, it's almost like a lens for where we are today to think about, well, what's most important to the type of business you're running, and then go look at that platform that most tightly integrates with that area. And I realize that'll change in 6 months to a year.
I was gonna say, that was my one caveat. I was gonna say, like, my best guess is that no one's roadmap is anywhere close to complete. So I think about like the things we're shipping in Q4, Q1 of next year, Q2 of next year. Like, we have a pretty good idea of what those things are. Now, if everyone else just stood still and gave us 6 months, in 6 months, we would be by far the best solution for every single advisor on planet Earth. Like, hands down, like, our capabilities will far exceed any other platform out there, standalone or otherwise, like meaning custodial connected or otherwise. But nobody's going to just sit around and do nothing for 6 months. Like, everybody's running at warp speed. But I wouldn't want that. Like,
take a vacation, everyone. Well, actually, on that note, though, we've been covering Denali a little bit here. Hazel is somewhat competitive to that. Do you see advisors using both Hazel and Denali? What do you think of Denali, and how do you think that'll end up?
So I've only seen like the videos that have been shared online. I've not done like a personal deep demo, but what does it say? It's like, whether it's, again, Denali or anyone else for that matter, what's exciting right now is the pace of change in wealth tech is like the fastest it's been in 20 years that I've been doing this. You think about try to think for a minute, be like, what did the years 2010 to 2020 give us? And like, you'd literally sit there going, I don't know. So what did we get? We got like Risk-O-Wise, which, that was, I guess, a hit, Wealthbox, Right Capital. I mean, we got like 4 or 5.
I call it the cloud migration. It was like
4 or 5 pretty good
cloud
companies, right?
Yeah.
And all of those companies are pretty good businesses. I think YCharts is in that category. There's a number of good, solid businesses, with good products. In the last 2 years, we've got like, I don't know, like that much innovation. Basically, a decade's worth of innovation happened in like, I don't know, the last 9 months.
Absolutely,
so it's pretty awesome.
Totally agree.
So I'm not too worried about who's gonna be this or that. I think it's like, look, we're all moving as fast as we can. People are having fun doing it. Teams are working crazy hours because they see these really massive breakthroughs with every release cycle. Customers are like, I mean, this has got to feel like the best time ever to be an advisor if you're into tech. Like Joe Moss has got to be like just having an absolute heyday just because there's something new happening every 2 to 4 weeks.
Yeah.
Which is great.
Everyone who's categorizing is having a great time adding things to their charts, right? So the business of categorization.
I disagree. Someone who actively does that, it's becoming a challenge. Yeah. But I mean, the whole concept of categories, well, that's the other thing. The whole concept of categories is sort of like, it's already a legacy concept. Like, there is no singular category to put these things in.
Yeah, there are a lot of
and in the past
lines. Yeah, I agree with you.
Yeah, and in the past 2 years, they blurred terribly. And even when I launched Wealth Tech Select, the whole concept of categories was only there to serve like kind of a legacy mindset. And we, very quickly ensured that we're really thinking about the full breadth of coverage and features and allowing users to kind of go through and see that. But aside from that, it's an exciting time for advisors. But the big challenge that they have is they're overwhelmed, right? They don't know where to start. I think that's the biggest challenge. And as somebody who consults with them on a regular basis, that's why they're hiring me. So from that standpoint,
good time to be in business.
It's a good time it's a good time for me. Yeah. But it's a lot. And I think one of the things that I try and tell a lot of them on the first time we ever talk is like, regardless of whether we move forward with anything, regardless of whether you hire a consultant to kind of help you with this, almost anything you choose is probably going to like be better than where you are today. Right. So like you could spend the next 8 months looking for the best thing for you, or you could do an appropriate amount of due diligence and make a decision.
Yeah, I feel really strongly about this because I know at the Advise AI show, people were saying, be careful about startups who, have a freemium tier. You might be the product. Everyone I talk to there, I would say maybe 95% of the people I talk to there are SOC 2 Type 2 compliant. They have free tiers where they do not monetize. They're not advertising to you. You are not the product. They're literally just giving you a free taste of, what you could subscribe to. And so it's actually the best time ever to just try a bunch of tools. Of course, it takes time to try tools, but I really feel strongly that you should try these new tools to see what's out there. And, you can learn a lot through that process. And I think that's what drives innovation as well, to have those early adopters. I'm sure at Altruist, you had these early adopters who had to place a bet on you, Jason, and you had the track record to show for it. But of course, as someone has to jump in. I mean, I do think one thing that's inhibiting innovation is these API gateways. I think this is something very specific to wealth tech. I've obviously been in a lot of different industries, worked at Google and Facebook, and then started companies in a number of different industries. And in a lot of those industries, you have open API platforms where you can sign up, get an API key, and start building and integrating data. And the data belongs to the user. Here, there's this weird concept where the data is seen to belong to the aggregator, and people are charging for access and acting as a gatekeeper. There's some weird kabuki theater or gates of Mordor to basically get access. And then, of course, then you see in pitch decks that this is somehow like a moat that, I have access. XYZ. I just think that's really counter innovation, unfortunately. But I did want to pivot into this because there was, JP Morgan struck a deal with data aggregators, charging them for client data access. And we had some people on LinkedIn, Craig Uhlenkott is an example, basically asking who owns the client data and where does Altruist stand on this. So I thought we could get into this, Jason. I would love your take on this.
Yeah, the short answer is our belief has always been that the advisor owns the client data, right? The data is theirs. This is a little bit different than access to APIs, though, and there's a whole host of reasons for that. Quick story too. I forget which conference I was at, but it was like, one of these conferences I was asked to be on a panel with a few other custodial leaders, and someone asked this question from the crowd. This was like a couple of years ago, pre-AI, being highly relevant. And I remember like all the other custodial people, they didn't even bat an eye, and they're just like, well, of course we own the data. Of course, like, it's not your data. And I think the context there was that, if you get a data feed from your custodian where they send an overnight file via SFTP, right? It's just basically a flat file, positions and, transactions and things like that. This is how like the Orions and, Adipars and Black Diamonds and even Ultras, like if we integrate with other custodians, they send us the data this way. And the problem a lot of advisors have is that they don't send any of the historical stuff. So back in the day, TD Ameritrade would send 10 years worth. After TD went away, no one would send any historical data. Like if you integrate with Fidelity or Pershing or something, and like your data is the day the connection goes live. I think Schwab would go back 2 years or something like that.
Do you feel that was that a moat decision? Was that a liability decision or something else?
I mean, for me, it's just a principle decision. Like in first principles, like it is. Why would you hold that data hostage? Like, I don't understand the logic behind it. So we've always had that approach. If you want your Altruist data, like we have an open API for data, and we have flat files for those who want to do an SFTP of overnight, basically a close of business file that goes overnight for reconciliation. And we have integrations with a bunch of companies, right? So we send data back and forth via API to like modern fintechs, like the Wealth Boxes of the world and Right Capitals of the world. And then we send flat files to your portfolio accounting systems, Orion, Black Diamond, Tamarack, et cetera, right? So we don't have much of a hard view there. APIs is a little bit different. We do have, we have a process if someone wants access to our APIs that they have to go through. Now, again, like what this means is like if you want to hit our accounts API to open an account on the Altruist platform, but from your own, kind of fintech or wealth tech, like that requires approval, and for a bunch of reasons. Like we don't want like everybody and their brother smashing those APIs, like slowing them down. Like companies are irrelevant; they have no business being in the they're just playing around, or they're creating like strange, almost like bot type attacks to kind of hurt our infrastructure. So for lots of reasons, you don't want all of your APIs open. But again, our data API is an open data API, and I think that's like the way it should be. I don't know why JP Morgan would do this necessarily, because they have plenty of profits. But I do understand why custodians can get a little bit cranky around data and around just some things in general. And part of it, it's like a whole nother fundamental question, which is, like there's advisors who wear with a badge of honor how much they kind of screw with their custodian and make sure their custodian makes no money at all. They'll be like, I go ahead, I optimize every penny of sweep to go into this blah, blah, blah money market fund. And I only trade these things. And I'm like, listen, the objective should be get clients great outcomes, not like make sure your custodian makes no money.
It's thinking of it as a zero-sum game that
it's weird.
Helping their clients by screwing the office.
Definitely not how it works, of course. And inevitably what'll end up happening is custodians will start getting squeezed, and they'll say, we're going to have to start charging you platform fees or minimum fees, or doing things like we're going to hold your data hostage so you can't leave, right? Or we're going to we're going to charge, I think right now there's a bunch of I was asked by some reporters to comment on like Schwab and Fidelity adding transaction fees or requiring rev share on ETFs or something like that. It's like, so you can, to me, it's like there's probably a bunch of strange reasons that custodians do the things that they do, but like the data ownership one is a kind of a head scratcher to me. But it's again all the more reason why, like I'm sure James, you probably suggest this to advisors, like as soon as you can, like get your own, kind of data warehouse if you want to keep it cheap, or if you want to be really usable, you do some type of a hybrid, with your.
It's definitely coming up more and more.
It's not a bad idea for people to just start collecting all of your data from all your vendors and just owning it and deciding what you want to do with it later.
Honestly, a year ago, I had like I shouldn't say a slightly different take. A year ago, I flat out said at a conference, like, if you're asking yourself right now, if you need a data lake and you don't know the answer, you don't. Was pretty much the comment I said. I don't feel the same way today, right? Like now I think there's a lot of valid reasons that smaller and smaller firms should consider that. It's just, what is it that you need to keep? What is the structure that you set up? Who do you use as a provider? All of that's come down in price too. So it's not as challenging. And a lot of wealth techs now have setting up a data lake that you own ultimately as part of it. And the only sort of caveat to that is you don't always own the transformation layer, right? How the data gets in there. So you may own the data, but you don't own the transformation layer. So that's the distinction.
Right? It's like it's still $20,000 or something, right? And so you have to have a really strong business case beyond just like we want to hedge or we want to have an insurance policy. You really need a compelling.
There are still lower cost options. I mean, like it might. I would look at that as like the initial setup. I don't think you're ongoing. But
the leading AI platform businesses, I think will kind of democratize that a bit. You know, like
it's happening.
Because if you look at like I look at like our usage on Hazel, and like I don't know, it's something like 30% of people sign up and they don't integrate any of their tools, right? They don't integrate anything. They just like use it to like, I don't know what they're using it for, right? Like maybe they don't even hit like, subscription after a free trial, but those who connect all of their tools, obviously it's so much more powerful if you do that. And, and obviously the likelihood that you'll stay on long-term is also higher. So I don't think it'd be like crazy for, for us or anyone else who has a little bit of scale to say, hey, listen, we're going to take like this collection of data that we display on a UI, and it's highly normalized data, and you accept it as being like source of truth, and like making this available wherever and whenever you want it. So I think like that would sort of make it pretty easy to have access to. It wouldn't be quite the same traditionally, right? Because you're not able to like just connect endpoints to that at all times, but you can extract it out into when you're ready to have your own data lake.
Yeah.
You can now pull it from one single source, and it's all clean and ready to go, and it's all the historical data, because obviously we want to keep all the historical data, not for our stuff, but like while someone's a customer, because we want you to be able to query it. Like we want you to be able to say, what did James and Mark and I talk about back in November 2025, and
this is what Invent is pitching, and I think they're pitching like an MCP endpoint for your data lake, which means you can plug it into a AI layer on top of it. But yeah, I guess, I mean, this API question does beg the question where if you, Jason, had API endpoints for create account and for, a lot of the things that Hazel is using, then what is the long-term differentiation there between Hazel and Jumper, Zox, who may then take advantage of those APIs for their Altruist users? Like, how would that actually pan out long-term?
Yeah, I mean, I don't think that would be a problem. I mean, the way I view things are, probably a good way to think about it is like, what we want more than anything else is for advisors to run their entire business on Altruist. Now, if they're using someone else's AI tools, like that's wonderful, frankly. It doesn't bother us one bit. If anything, our gross margin probably just increased because we don't have to support the cost of that AI tool, Right. So I think a lot of it, if you look back at like TD Ameritrade's, old strategy of like kind of an open API through Veo, I think in some ways it was really brilliant. Like they basically got, 100 smaller fintechs to be out there integrating with them, to be promoting their integrations with TD. And so anybody who wanted the efficiencies of all these smaller fintechs, the way you got them was you had to be at TD. Like that's, not necessarily a bad business development structure. So for me, I'm not too bad of shape. I view it like, we're going to keep building Hazel because we'd like to control, sort of our destiny. And we want to make sure that there's amazing AI tools for advisors that use our platform. But I do suspect there'll be a day where it'll just kind of be logical for us to say, hey, like all these other tools, they have some level of critical mass, customer loyalty. We shouldn't make it harder for them to use Altruist. We should make it easier for them to use Altruist. What I don't want to do is like wait around for that. Like, I don't want to wait around and like hope that somebody's going to, say, oh, listen, like, because if you're these other companies, and I say this as respectfully as I can, but like the technical moat of any AI company is pretty low right now. Like everybody with the right talent people on their team, you have like 10 talented people, you could catch anybody's feature capabilities today. Like if you just begin like moment time, within 12 months, nothing that's been built up to this point couldn't be rebuilt probably inside of the next 12 months. So it's not like there's like a huge product moat around most of these tools, including our own. Like these are with the right group of people with about a year's time, you can build pretty much all of these different tools.
Yeah. Imagine the challenge that Knapsack has with 0 talented people. It's really
That is not true at all. You're always shocking me with like how like advanced and like you push the needle on pricing. It makes even us uncomfortable, right? And like we're kind of like known for being the ones that make everyone uncomfortable with pricing. But yeah, I think like the thing that like what did make certain companies bigger faster? And Mark, I'm sure you've probably spent a lot of time going like, well, how did these other guys get to 25,000, paying subs so quickly? And the answer is they went much harder at go-to-market, much faster than everybody else. That's just the reality of it. Now, the reason why that's relevant to us is if someone's taking the majority of their resources and they're kind of saying, hey, I want to be approved by LPL, Cetera, Osaic, I want all the big networks. I want to be in those things. I want to sell into enterprises. The priority of an Altruist integration, a really deep one that's super powerful, is naturally not going to be incredibly high, right? Nor should it be. They're what they're trying to do is a land grab of subs, right? Get 20, 30, 40,000, some massive, number of subs. Now, interestingly, as time goes by, our motivation changes significantly, because our motivation will be damn, you guys have 50,000 subscribers. It sure would be nice if they knew that there was some superpowers that, Zox could unlock on Altruist that you couldn't get, via the whatever LPL integration or something like that. So I do think all these things will come full circle, and companies like Altruist will be very keen to partner with all of the, best leading AI companies. They also everyone will have to kind of evolve their tech a bit, because right now, again, the biggest differentiator I can see is mostly go to market. Some companies just have bigger teams, more resources. They've spent more money, and they've went out and they've secured larger enterprise kind of distribution agreements. And that's why they have the market leadership, so to speak. Not necessarily in an eval, they're 10 times better than everyone else. I don't know that there's I don't even know if there's been anyone. Have you guys done an eval yet? On our industry tools? I'd be curious if there's any real difference between the top 10.
A third party eval on the quality. Is that what you're saying? We did eval on the quality of note taking a little bit. I mean, we had to design the eval from scratch. I would love, obviously we're a little partial, right? So I would love someone impartial to come out with an eval that everyone can run themselves, right? These evals, it works the best if it's open source and people can run it themselves. And then, that would be phenomenal, right? I think there's a little bit of subjectivity I found, especially when I talk to a lot of clients. People think of the tone. Obviously, there's accuracy, but a lot of people think of tone and comprehensiveness and readability. And those are a little subjective, I found, for any AI output, but especially notes, I found.
Yeah. No, I tend to agree. I think I think also the more you use something, the more biased you become, because it starts to learn from your preferences, and
memory is powerful.
Less.
That's one thing people forget. There is a lot of these products do have the ability to configure it, and you have to take the time to do that to get the ideal results, right? They can work pretty well out of the box, but they have to learn about your firm, learn about your tone, etc. And that either comes from the history and the interaction, or it comes from the configuration with the application itself, right? And giving it access to some of those things. But Jason, you've been very generous with your time. This is easily the longest podcast.
Do some editing. You'll smart editing, and it's down to 40 minutes.
We'll see. I don't know. It was good. It was good stuff. I don't really want to edit anything out, but I do want to pivot to our rapid fire questions, and I'm going to lead it off with kind of picking up on a topic we already discussed. So we talked about whose data should this be, and it was, really custodian or advisor. But I have a question: should it be the client? And is that maybe where the future is anyway, with the way regulations are going? Not necessarily in the US, even though there's some client portability regulations coming in place in California and others, but more so maybe in Europe, where some of that is going to drive regulation changes here as well. At least that's my assumption.
I don't think that'd be a bad thing. If that's how it ends up, then so be it. The nice thing about I don't know, maybe this is not entirely unique to the Altruist platform, but in order to open an account at Altruist, the client has to have a portal, right? So we have a web app that's used by hundreds of thousands of consumers, and a mobile app with, probably north of 50,000 downloads. So probably the largest consumer app of any advisor or wealth tech product out there. So yeah, if we needed to push data to the client, make it easy for them to own their data, it'd be very easy for us to do. So yeah, maybe let's push for that. But again, I'm fairly indifferent. I don't know what most people would do with it. It kind of reminds me of the query where you ask OpenAI or whomever, pick your favorite model. You're based on everything about me, point out my problems. It's and then you're cool, novel thing, move on to the next thing. But AI does know a lot.
Less is putting AI on top of it, although that's a potential use case. I think about it more so for being able to use it to either open new accounts or different types of accounts elsewhere for other sorts of grander purposes. There'd have to be more architecture around it. But it's my data, it's my history. I should be able to take it where I want.
It'd be kind of interesting. It reminds me a little bit of like the medical industry where, you switch dentists and, your files go from one dental office to the next one, and makes it a little bit easier for the new dentist, especially with AI, because now the new dental office gets the old information, can quickly query it and know like all sorts of things about you much faster. So
Exactly.
maybe not a bad thing
That's
for
where I'm going.
consumers. Yeah.
Yeah. I think, that's the way Europe went with open banking standards. It seems like that it's a lot easier for Europeans to do it. I do have one rapid fire question, which is a little bit of a spicy one. So, Robinhood's TradePMR acquisition, do you think it'll succeed or fail?
Well, I think again, it's one of these zoom out questions. I think 5 years from now, I think they'll probably have a pretty compelling advisor product. And it probably won't be called TradePMR, and it probably won't be, honestly, a single line of code from the Fusion platform that TradePMR built, which, for a lot of good reasons. That one sits on top of, First Clearing, Wells Fargo's clearing platform. So it only makes sense eventually Robinhood to bring clearing in-house. The challenge they have right now is that they don't support, about 40 account types that are necessary to support advisors. They don't support a bunch of different asset types like fixed income or alternative investments. They don't support any integrations because they've never done an integration with, advisor platforms. So they have a lot of building to do, just like we had to build from scratch. It'll take, even with a killer team and a big budget, it'll take, at least a couple, 2-3 years to kind of get that first version out. Then they'll have to migrate the assets. So that takes about a year of planning and regulatory approvals to convert the assets from First Clearing over to, whatever they end up calling the new Robinhood platform. And so there's just a lot of change management, that just inevitably is going to take some time. But I do suspect, like, if we're having this conversation in 2030, they've probably got a pretty, if they want to, it all depends on, like, if you're Vlad and you're going, I can spin up a prediction market business literally in like 3 months and generate hundreds of millions of dollars of free cash flow, or I can slog away at building an RIA custody and clearing platform for the next 2 to 3 years, sink hundreds of millions of dollars into R&D, only to earn 12 basis points, in gross revenue and basically no profits. I mean, they just have to make the decision. Like, if that's what they want to do, they have the means to build something really good. The short term, if you're watching, just go check out the public. Robinhood is a great investors.robinhood.com. You can see all of their kind of data that they share. And you'll see from time of acquisition to today, the kind of best guess is they've probably seen a few billion of outflows, since they started. In other words, like, assets are like largely flat in spite of a market being up like 20% since date of close. So it's so far, it appears that, the things they're trying to do to grow that business, advisors are maybe just, and it probably has nothing to do with the tech, right? It probably has nothing to do with the people. I think it's just some advisors are like, hey, I don't know how my clients feel about this. Like, it's like a trust thing.
I was going to bring up the trust thing, because if my advisor said we're moving to Robinhood, I'd say, see ya. I don't think that's just not a company that I care to do business with based on kind of their past experience. There's a few others that I won't name that I feel the same about. Right.
Yeah. I don't think
it might also be a generational thing, right? I guess it also could be that they're appealing to a different generation and just sort of and there's also a branding thing. You're assuming that there's Robinhood as the branding. They might keep the TradePMR branding, right?
I mean, I would be willing to bet like a meaningful portion of my net worth that they don't. I mean, only because, like, why would, again, I actually have gotten a chance to meet Rob a couple of times. Awesome guy, incredible foresight. Like, he literally launched that business when RIA custody was basically, it was like such a non-thing, like maybe under 500 billion of total assets. So the fact that he did it, stuck with it, former RIA turned, custody leader, like, good for him. But even he said, like, yeah, in hindsight, I wish I wouldn't have called my company TradePMR. I think he had like a different name, but like the regulators wouldn't let him take it. So he just like quickly like whipped up a name, and then it just sort of stuck for 20 some years. Given how much Robinhood spends on brand, I just don't see a world where they, like, so keep in mind, like, for better or worse, Robinhood is known by 80% of Americans right now. TradePMR is known by like a less than a fraction of a mil, right? Like, it's like, you're talking about maybe a few thousand people have any idea like what it is. So that brand value, for better or worse, is like, there's something there. There's some real value. Yeah. And I do think it's more of a generational thing. So, like, if you're trying to, my oldest son is 25 years old, right? If you're trying to court him as your client, he doesn't think Robinhood's a bad company. He's totally fine with it. If you're trying to court my generation, mid 40s, we're probably a little bit more skeptical, right? And then if you're like my parents, they've never heard of him, so
Yeah.
Fair point.
it's going to take.
Yeah.
So over the next 10 years, though, I mean, if all these kind of like generational wealth transfer things come true, like, yeah, there's some real value in the 29 million or whatever it is, account holders, 13 or whatever it is million monthly active users. Like, there's some serious value there that, no RIA has that. Like, I'm pretty sure the cumulative number of customers of all RIAs in America is probably somewhere around that same number, like, right, 13 or 14 million, and their customers are not active, which is probably a good thing. And so there's definitely some, change on the horizon. It's hard to know, but yeah, our view, because I've had some people that are like, I actually had somebody, I don't know, it was like somebody's like, I know what it was. It was like a disgruntled former employee, and they're like, Altruist is reacting, like they're really afraid of, like, Robinhood. And I'm like, I think very highly of the company, but I can promise you that, like, other than when someone asks me a question like this, like, the thought crossed my mind, like, for 2 or 3 minutes a year, like, what they're up to. Like, it's a totally non-relevant thing. But if you're prompted and you start thinking about it, you're like, I think anyone to dismiss them is like very, very foolish. It's very similar to those who dismissed Schwab 25 years, 30 years ago. They're just a discount broker. No one with real money will ever go there. And now they've got, whatever, $11 trillion.
Yeah, I think that's where my head's at. I mean, I think for all the reasons you mentioned earlier on the podcast, like, there's so much potential in modernizing the stack for the advisor. And I think they can really do a good job there. And I also think some of the brand things you mentioned are very specific to a very small set of online people who are just very hyper informed. And I think for most people, they probably don't think twice about it, right? I imagine that's probably going to be ultimately a safe bet. So I think there's a lot of potential, but I think it'll make things a lot more interesting. And also just the market share. I mean, the incumbents still have the massive, lion's share of the market, right? So there's so much room, I think, for any challenger.
The biggest challenge I think they'll run into, again, it's part of it's the will, not the skill, so to speak. But the part of why the will be interesting is that their consumer product, if you were to take that exact consumer product pricing and apply it to an RIA model, you couldn't make it work. Like the math wouldn't work. In other words, like, paying basically all of the net interest income, like if you basically like a Robinhood Gold for advisors, like charging $5 a month to basically give away all the economics on cash, or almost all the economics in cash, commission free everything, lowest, really low margin rates, and then hope that you make up for it on, because their consumer product, it's like a third of the revenue is options trading, a third of the revenue is crypto trading. Advisors do neither. They do some options trading, but it's very negligible. And they do, again, some crypto, but again, on a relative basis, like negligible. So you start taking that pricing, and so what'll end up happening is, again, if they decide to take the pricing and make it consistent across the platform, it's going to be a business that just doesn't make much sense to run. And then you run into the same conundrum that Schwab and Fidelity have, which is, well, what if we price it kind of good if the client stays directly with us? And we make it kind of not so good if it's with the advisors, because, like, we can't make the math work because the advisors' behavior is just too darn good. They don't trade enough. They don't hold much cash. They don't use exotic investments. They're not betting on sports and political, elections and whatever else. So consequently, we cannot make money unless we do something different from a pricing perspective. Now, as an advisor, you have to then make a decision. Like, do I want to bring my clients to a platform where the consumer version's better than my version? The clients earn more yield. They pay lower expenses. They have better technology. There's bigger R&D budgets behind it. And this is exact same things happened at Schwab and Fidelity for the last 20 plus years, where it's like their consumer products are pretty darn good. Tons of R&D going into those, but their economics are way better. Like, they make way more money on those products than they do on the advisor side. And so these are kind of things that, like, again, I don't think they'll be, if it was their life's mission to go build the best platform with killer pricing. I mean, look, they've got $4.5 billion in cash in a stock price that's trading at something like 35 times revenue. So I think they probably could do whatever they want to do. But you have to kind of ask yourself, like, would you really want to do that with your capital? It's like, when there's these other things you can do that you're generating 200 basis points of return on customer assets versus 10 or 12.
Interesting analysis.
Jason, yeah, you've been more than generous with your time. This has been fantastic.
Gotta fly though, yeah.
From discussing smoothie recipes to simplifying clothing decisions, 14,000% growth, and the history of Altruist and everything. This has been a really fascinating discussion. I'm really appreciative of your time and coming on board today.
You guys are so gracious as well. So thank you a ton for having me. And I can't wait to not listen to this episode, but listen to all the other ones that are coming up afterwards.
I don't listen to any episodes. I honestly listened to like the first one or two, and then I was like, I think I'm done listening to myself.
Listen, I listened to some of the other AI founders, and I'm like, man, like once I knew you guys were gonna have me on, I was like, I'm gonna appear really dumb because some of these people are really smart, you know. So I just hope on like a level of dumbness, people are kind of like, okay, well, you know, Jason's like at least half as smart as the other people that you've had on, and that'd be like kind of reasonably good accomplishment.
I think you nailed it.
Perfect.
I don't know if you're familiar with Top Gear, but we're not doing, you know, like an intelligence lap times at the end of every show. But I think you nailed it regardless. That was a solid lap, Jason.
All right. Well, so fun, guys. Have a great one. Talk to you soon.
Thank you very much.
Take care.